percent of overall EVs that ultimately are going to be using the charging stations, what they're going to be charging per kilowatt hour. And then the important things, guys, that most of the bears will say, well, today everyone just charges at home or they charge at their office.
Better than expected. Now, that's perhaps the best way to describe Tesla and its stock. So Wedbush analyst Dan Ives is on point on that one. What's more, he believes that there's more room to run for the EV leader after its latest bullish Q2 delivery numbers. For context, Tesla reported a record second quarter deliveries of 466,000 ahead of Wall Street's 447,000 consensus estimate. Production in the quarter also rose to 479,700, which Ives said was evidence of improved capacity and a healthier macro in a research note.
But it's also looking at now down the road, how many are going to be using these charging stations? And when you look right now, they're going to be the only game in town. That's why you have GM, Ford, and others going toward Tesla. And I think today it's superchargers, next is going to be batteries, and then eventually FSD AI. This speaks to our thesis similar to Apple on the services side. This is just the early stages of Musk and Tesla monetizing.
The numbers are proof to combat the narrative of a murky backdrop and should put the bears back into hibernation mode, he added. It is no secret that Dan Ives is a Tesla bull. You are all aware that the news of Tesla's partnership with Ford and GM was well received. In fact, Tesla shares set a fresh 8-month high a few days back, jumping 4% to $244.50 after the firm announced that it will open its supercharger network to General Motors electric vehicles, coming on the heels of a similar announcement for Ford EVs. This represents a large monetization opportunity for Tesla, Wedbush analyst Dan Ives said in a recent note to clients, upping his price target for Tesla by 40% to $300 at the time.
Where are we on the roadmap of price cuts in terms of Tesla, which Elon Musk has clearly moved to put, growth ahead of profitability?
Yeah, and I think that's been the right poker move. And I think it's paid off significantly, especially in China. I think now, look, 96% of those cuts we think are in the rearview mirror. And I think you saw maybe some overreaction last week, and you've definitely seen a rebound as I think more investors are recognizing that. But right now, margins suffering at the cost of units. Now, I think that troughs over the next quarter or two and starts to rebound into next year. And that's the yin-yang that they're going to strike. But ultimately, it continues to be Tesla's world, and everyone else is paying rent in terms of overall EVs. And I think that's becoming clearer and clearer.
In a note to clients, Ives called Tesla a golden EV success story. He highlighted the growing adoption of Tesla's supercharger network and added, "We expect more names such as Hyundai, Honda, Acura, and other large OEMs to follow suit." Well, some actually did. A long line of rival automakers have thrown in the towel and agreed to join Tesla's supercharger network. Ford Motor Company was the first to break with tradition back in May, and it was quickly followed by General Motors and Rivian. Several other automakers joined the trend in rapid succession, including Volvo, Polestar, Mercedes-Benz, and Nissan. In light of this, Tesla is set to access up to $20 billion in revenue from its recent supercharger deals with Ford, General Motors, and various other automakers, according to a recent note from Dan Ives of Wedbush. It is worth noting that Tesla is also working to secure its share of the $7.5 billion in U.S. government subsidies designed to accelerate the installation of as many as 500,000 high-speed chargers on the country's busiest highways. The Biden administration has been clear that Tesla would only be eligible if other automakers were granted access to its network. Spending on Tesla's supercharger network has been significant, with charging stations costing a hefty $42,000 per connector. The resulting financial burden aside, Tesla stations are much more cost-effective compared to the $100,000 to $250,000 per connector spent by rivals, according to a report.
So in terms of the stock, it's up 10% this week. It's down 10% over a month. And the reason, I'm trying to get the correlation here between it and the NASDAQ. If the NASDAQ continues to have some trouble and big tech in general pulls back, this stock is going to be susceptible to that as well, don't you think?
Of course. Yeah. I mean, look, we continue to view Tesla as a disruptive technology company, not an auto player, right? But it's our view going the second half of the year. I think tech stocks rip higher. I mean, it's my view that the new tech bull market has already begun. I think growth is going to exceed street expectations. And I think what we saw with NVIDIA, that's just the appetizer to what we're going to see with this $1 trillion tidal wave of spend over the coming years for players across the tech ecosystem.
Undoubtedly, Tesla's supercharger network is the most robust and expansive on the planet, and earlier this summer it gained massive attention when it struck deals with various OEMs to allow their EVs to access the charging infrastructure starting in spring 2024. In another note to investors, Ives said, "To dive deeper into this sum of the parts valuation, we modeled and projected out Tesla's supercharger network, taking into account access and revenues from other OEMs using stations across the United States. Ultimately, we estimate that Tesla's supercharger business will be roughly 3 to 6% of total revenues, translating to a $10 billion to $20 billion business by 2030. Ives wrote in the note that while the supercharger network opening to OEMs is a major part of the Tesla story, it is just one part, which implies that there are more, which there are. Strong production figures, a thriving energy business, continuous improvement on the side of the development of autopilot and full self-driving, an unmatched battery ecosystem, and increased production and scale scope are all contributing to a strong financial sheet for Tesla. We believe Tesla is in a prime position to further capitalize on the EV transformation taking place as part of the government's plan to reduce carbon emissions to zero by 2050, Ives wrote. Simply put, Ives is a firm believer in Tesla. In fact, he said, "Tesla is in a massive position of strength after building its EV castle and now is set to further monetize its success," pointing to the company's increasing ability to bring in revenue outside of EV sales. Tesla should net another $3 billion in new revenue from Ford and General Motors EV users, Ives estimated. Ives noted that earlier this year, Tesla agreed to add 7,500 superchargers to its network by 2024, more than doubling its current capacity of roughly 5,000. He suggests that the increasing number of deals with other automakers will accelerate its growth. Tesla's network is almost entirely solar-powered, so the energy generation costs are negligible. As a result, Tesla's supercharger network will represent a large monetization opportunity and account for roughly 3% to 6% of total revenues, translating to a $10 billion to $20 billion business by 2030, according to Ives. This implies that Tesla stands to generate total revenue of more than $330 billion by the end of the decade across its sprawling business, a hefty increase from the $94 billion it reported over the trailing 12-month period. A few weeks ago, Ives gave Tesla stock a buy. His price target is $350 a share, one of the highest on Wall Street. That worked out to about 73 times his 2024 earnings estimate of $4.80 a share. Overall, 39% of analysts covering the company rate shares buy.
Now it's having its pause, pullback, whatever you're going to characterize that as. I mean, what do you want these stocks to go up 60 and 70%? For the year?
Well, I mean, my view is, first of all, way overcorrected last year. I mean, that's our opinion. And I think now investors more and more going to 2024, 2025, looking at a cycle that we haven't seen in 30 years. Now, of course, rates, as you asked the professor, that's clearly going to be a headwind. But when I look across tech, when I look across software, cybersecurity, chips, I view this as a time where we view it as the start of a new tech bull market, not the time where we're hiding because of valuations. I think these stocks grow into their valuations over the coming years.
Raising his price target for the EV maker to $350, Ives argued in a note that Elon Musk's company has demonstrated that it can monetize key products, including its supercharger network and self-driving tech. Tesla is currently trading at around $250 per share, $100 short of Ives' price target. Unsurprisingly, Tesla bears do not share Ives' optimism on Tesla stock, especially since Tesla stock has been falling ever since the company reported earnings in July, largely over concerns of weakening margins and continuous price cuts. However, the company, which is still up more than 90% for the year, is just at the beginning of its growth, Ives firmly believes. Ives further said that the Tesla bears are negative because they are looking at Tesla as a car company. He, on the other hand, remains incredibly bullish on the company's outlook because, similar to Cathie Wood of ARK Invest, he views the company as a major player in the tech and AI space. Bulls have disruptive technology, and that continues to be the big debate around the name, Ives said. I've always viewed them as a tech play, and I can argue the FSD angle makes them one of the best AI plays when you look down the road 3 to 5 years. And Tesla as a tech company rather than a car company is something that will achieve profits through the monetization of certain invaluable services, Ives said. The company's supercharging network represents the very beginning of this monetization. Ives and his team released new projections around the Tesla supercharging network last week, saying that the network could bring in up to $20 billion in revenue annually by the end of the decade, an amount equivalent to around 6% of Tesla's total revenue. This latest model is based on the assumption of broader EV adoption, with Ives looking at EVs to make up around 20% of all cars by the end of the decade, compared with the current ratio of 3 to 4%. There's a lot of variables, Ives said of the model. One is the vast majority of charging today happens at home or place of business. This is under the scenario that more EVs are being used outside of just commuting, driving around, and also being charged at their own long distances. Make sure to subscribe for more.